Unveiling the Federal Reserve's covert, ever-expanding bank rescue plan. When we hear the term bank bailout, we often think of the Great Recession and the financial crisis. However, what many people don't realize is that a similar bailout has been happening behind the scenes in the banking system since March 2023. This ongoing bailout, which involves the purchase of United States treasuries by the Federal Reserve, has been growing steadily and is scheduled to end in March 2024. In the next few minutes, we will explore the implications of this bailout for banks, treasuries, the bond market, and the overall economy. The origins of the bank bailout. To understand the current bank bailout, we need to go back to 2020 when loose monetary policies were implemented to stabilize the economy. Banks, like many other entities, were sitting on a significant amount of cash and were unsure of what to do with it. With the Federal Reserve assuring them that interest rates would remain low, banks loaded up on U.S. treasuries, considering them a safe investment with a risk-free return. The problem with bank holdings of U.S. treasuries. The price of bonds and the yield on bonds are inversely correlated. If interest rates rise, the value of existing bonds decreases. This poses a problem for banks that hold a large portfolio of U.S. treasuries, as rising interest rates can lead to significant losses. If banks were forced to sell these treasuries at lower prices, it would trigger a downward spiral in the bond market, pushing interest rates even higher. The Bank Term Funding Program, BTFP. To prevent a collapse in the banking system, the Federal Reserve created the Bank Term Funding Program, BTFP, in March 2023. This facility allows banks to sell their underwater treasuries to the Fed at full price, effectively unloading their losses. Banks can access the BTFP by submitting a request via email to their lending reserve bank. The BTFP has been heavily utilized, with usage reaching record highs of $141 billion as of January 2024. The indirect bailout of the Treasury and bond market. The BTFP not only bails out banks but also indirectly supports the Treasury and bond market. If banks were forced to sell their treasuries on the open market, it would lead to a fire sale, pushing prices down and interest rates up. However, by allowing banks to sell their treasuries to the Fed at full price, the BTFP prevents any downward pressure on prices. This, in turn, supports the entire bond market, as treasuries are considered the bedrock and safe haven asset. Implications of the BTFP's expiration. The BTFP is set to expire in March 2024, and banks are taking advantage of this last opportunity to unload their underwater treasuries. However, it is unlikely that the Federal Reserve will extend the program, as the need for it is diminishing. The reverse repurchase facility, which attracted cash from money market funds, is being drained as investors opt for higher interest rates offered by the U.S. government through Treasury bills. This influx of cash back into the banking system reduces the risk of deposit flight and the need for banks to sell their treasuries at lower prices. Conclusion. The ongoing bank bailout, facilitated by the Bank Term Funding Program, has been crucial in preventing a collapse in the banking system and supporting the Treasury and bond market. However, as the need for the program diminishes and cash flows back into the banking system, the Federal Reserve is unlikely to extend it beyond its expiration in March 2024. The implications of the program's end remain uncertain, but it is essential to monitor the potential impact on banks, treasuries, the bond market, and the overall economy.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.